You know the US dollar, right? We all do. I mean, it's the money we use, the currency we see in headlines all the time.
Yeah.
But have you ever paused to truly think about the sheer, almost invisible global power it wields? It's not just the money in your pocket. It's this financial behemoth with a surprising, really complex history that's shaped our entire economic world in ways we rarely consider.
It's absolutely true. The dollar's journey, it's far from just a straight climb to the top. It's a story full of dramatic shifts, unexpected challenges, and these really pivotal decisions that have left, well, an indelible mark on international finance.
Yeah.
We're going to try and peel back those layers today.
Yeah, exactly. That's why we're taking this deep dive into the dollar's international role.
Yeah.
Our mission really is to unpack these complex concepts using what we like to call the Feynman technique. That means we'll try to explain each idea simply, highlight where we still need to explore deeper, those crucial knowledge gaps, and connect everything with, relatable analogies. So you, our listener, walk away truly well-informed. We'll trace its path from its unexpected rise amidst the British pound's dominance back in the early 20th century through pivotal moments like the Petrodollar agreement all the way to its current status and the very real debates about its future.
And for this journey, we're drawing on a pretty rich stack of sources. We've compiled historical documents from the Federal Reserve and the Office of the Historian. These are complemented by some really in-depth analyses from institutions like the International Monetary Fund, the IMF and the Atlantic Council. Plus, we've pulled from academic research that delves into the intricate origins of global financial markets. It's a truly comprehensive look at how we got here.
So whether you're grappling with global news, prepping for maybe a high-stakes meeting, or you're just intensely curious about how the world's money really works, this deep dive is your shortcut. It's your way into understanding the powerful forces shaping the international financial system. It's a fascinating narrative, so yeah, let's jump right in.
Okay, let's unpack this with Section 1. The dollar's historical rise from gold to global dominance. Our story really begins in a time before the dollar's undisputed reign with something called the gold exchange standard.
Right. To explain it simply, just imagine a global economy where physical gold was seen as the ultimate form of money. Under what's known as the gold standard, a country's currency was directly convertible into a fixed amount of gold. But, well, there was a problem.
Okay.
Holding vast quantities of actual gold bullet, huge, heavy bars was incredibly expensive to transport, to secure, to manage. It was just cumbersome for central banks. So to economize on these real resource costs and make the system more efficient, countries evolved towards the gold exchange standard. So a more practical solution then. A bit like, financial alchemy.
Precisely. Instead of central banks needing to hold all their international reserves in physical gold, they could hold foreign currency that was itself reliably convertible into gold. Think of it this way. Instead of keeping every single penny of your life savings in physical cash under your mattress.
Right, which nobody does anymore.
Exactly. You deposit most of it into a secure bank account. That bank account promises to give you cash whenever you need it, but it allows the money to be more easily used and circulated within the economy without the constant physical transfer of notes. This system aimed to make the existing global gold supply go further economically.
That makes perfect sense. A way to stretch the gold supply and make transactions more fluid. But it sounds like a clever workaround that built on a fundamental constraint. Given that, what were the early warning signs? That this efficiency might come at the cost of stability.
That's a crucial question because, its origins already held clues to its fragility. This system gained significant traction after World War I. The war had caused substantial inflation globally, and with soaring prices and increased economic activity, there was this perceived need for larger money supplies to facilitate trade and growth. However, new gold production simply hadn't kept pace with this demand. This imbalance led to concerns about widespread deflation, which nobody wanted. The solution, which was proposed and discussed at the Genoa Conference in 1922, was to further institutionalize the gold exchange standard. This encouraged central banks to hold approved assets, things like bank balances, bills, or short-term securities denominated in currencies of countries that had already restored their own gold convertibility.
So mainly the British pound and I guess the US dollar?
Primarily those two, yes. Especially the pound initially, but the dollar was gaining ground. It was seen as a vital way to address a gold maldistribution, where too much gold was concentrated in just a few countries like the US and France, leaving others really strapped for reserves.
Okay, so on the surface, It looked like a smart, efficient way to manage a global shortage of gold. But underneath, it was inherently fragile, wasn't it? It sounds like a house of cards.
It truly was, despite its initial promise. As historical sources vividly describe, this system had critical vulnerabilities that could trigger rapid destabilization. Events like embargoes, for example, could suddenly disrupt the flow of these approved assets or the ability to convert them.
Right.
Even more dangerously, there was the risk of central banks strategically liquidating assets. Essentially, a major financial power selling off a large quantity of another country's reserve currency in the market. This could intentionally drive down its value, making it harder for that nation to maintain its fixed convertibility to gold. Or a reserve center country might unilaterally devalue its own currency against gold. That would instantly inflict massive losses on all foreign holders of its reserves, throwing the entire international system into disarray. A powerful and frankly catastrophic example of this was the devaluation of sterling in 1931. This wasn't just a minor blip. It inflicted massive, sudden losses on central banks and other holders of sterling reserves. It led to a catastrophic collapse of the foreign exchange component of global reserves. This event cascaded through the system, exacerbating the deflationary pressures already gripping the world economy at the time.
Wow, that's a stark reminder of how interconnected and, well, delicate these systems can be, especially when confidence is involved. So if one key currency's stability was compromised, the whole structure could begin to collapse like dominoes, leading to a cascade of currency liquidations and serious economic stress.
Okay, so beyond the 1931 sterling devaluation, which is a huge event, what were other specific instances or maybe perceived threats that highlighted the inherent fragility of the gold exchange standard in the interwar period? And how did central banks try to mitigate these risks? That's our first knowledge gap.
Moving on from that fragility, what's truly fascinating here is how this period fundamentally challenges our long-held understanding of currency dominance. For decades, the conventional wisdom, largely popularized by economists like Robert Triffin, who famously described the Triffin dilemma.
Right, the dilemma of a reserve currency. Exactly. That wisdom held that the British pound sterling remained the unchallenged dominant international reserve currency throughout the interwar period. The story was that its deep historical incumbency advantages and powerful network effects made it incredibly difficult to unseat, and that the US dollar only definitively replaced it after World War II.
That's what I've always read and understood,
Yeah.
that sterling was king until Bretton Woods, basically. So you're telling me that this widely accepted narrative, which has influenced how we think about reserve currencies, is actually being rewritten?
It absolutely is, and it's a significant plot twist in economic history. A deep dive into newly unearthed archival data from central banks. We're talking ledger entries, correspondence from institutions across Europe. It presents a strikingly different, more nuanced picture. Researchers found that the US dollar actually overtook sterling as the leading reserve currency as early as the mid-1920s, specifically around 1925.
1925. That early?
Yes. And then it widened its lead through the latter half of that decade. This directly challenges the entrenched idea that inertia always delays the transfer of leadership in such a profound way. It suggests that shifts can be more dynamic and rapid than we previously assumed.
That's a huge revision to our understanding. Okay, so the dollar was leading in the late 20s, but then what happened? Did sterling just, I don't know, gracefully cede its position?
Not at all. The story continues to defy expectations. Following a significant event, the devaluation of the dollar in 1933, where the U.S. effectively cheapened its currency against gold to combat the Depression, sterling remarkably regained its position as the leading reserve currency.
Wow, a comeback.
A real comeback.
Yeah.
And it maintained this dominance through the remainder of the 1930s. This resurgence was particularly evident among countries in the traditional sterling area, like the Scandinavian nations, which maintained close trade and financial ties with the UK. Even in Central European countries that were rebuilding their reserves during this period, they often favored sterling as a stable asset.
So dominance isn't necessarily forever. Once lost?
Exactly. It demonstrates that currency dominance, once lost, isn't necessarily gone forever. Think of it like two top-tier athletes competing for the #1 spot in a global championship. One takes a lead, maybe sets a record, but then, due to an unexpected rule change or perhaps a strategic misstep by the leader, the other makes a strong comeback. It proves that leadership can shift back and forth, defying predictions of permanent dominance.
That really challenges the idea of a single immutable dominant currency or an irreversible trend. It sounds much more like a dynamic competitive duopoly.
It does indeed. And crucially, these new findings also challenge the notion that there's only room for one dominant reserve currency. The evidence strongly suggests that sterling and the dollar often shared reserve currency status, acting more like a duopoly for much of the interwar period.
Both viable options.
Exactly. Both New York and London offered deep, liquid financial markets without significant capital controls, making them highly attractive places to hold reserves. New York was emerging with its own robust capital markets, while London, of course, had centuries of financial expertise. The idea of a single, overwhelmingly dominant currency, like the dollar after World War II, might actually be the historical anomaly rather than the norm.
Interesting.
So instead of one single universally preferred global language for finance, imagine two main languages, maybe like English and Spanish today, being equally essential for international communication. Central banks would choose which one to speak or hold based on their relationships, their trade patterns, their specific financial needs.
Okay. And what about other players? Was the French franc ever a serious contender to join this duopoly? I seem to recall France trying to build up Paris as a financial center around that time.
That's a good point. While there was a substantial contemporary literature and certainly political rhetoric about France's ambitions to elevate Paris as a financial center, especially after their post-war economic stabilization efforts, the French franc never played more than a minor role as a reserve currency for other nations.
Well, just minor.
Just not minor. Even when the Bank of France itself accumulated massive foreign exchange reserves in 1926-27, largely by buying sterling, actually this influx only briefly allowed sterling to regain leadership because of the sheer size of these holdings by France. It wasn't because other nations suddenly started holding the francs as a reserve. The franc itself just did not become a significant reserve asset for other nations. Its role was quite limited compared to the dollar and sterling.
Okay, this is truly fascinating because it really redefines a key period in financial history. So my next knowledge gap question is this. What specific economic or political factors made the dollar so attractive to central banks in the mid-1920s? What allowed it to initially surpass sterling, especially given the UK's centuries of financial expertise and the pound's really established network effects? What exactly changed in that decade to give the dollar its edge?
Building on that, let's fast forward to the post-World War II era. This period truly cemented the dollar's global power and moved us definitively past that interwar duopoly. Immediately after the war, foreign countries, particularly in war-torn Europe, found themselves with unprecedentedly high gold and dollar reserve.
Right.
This was largely a result of wartime lend-lease operations from the U.S., which provided allies with military and economic aid, and also due to supply shortages during the war that simply prevented these countries from spending their accumulated funds.
So they had the money, but nothing to buy.
Pretty much. However, from a late 1945 onward, these reserves were rapidly liquidated. Countries desperately needed to pay for massive U.S. exports, food, raw materials, manufactured goods for relief and reconstruction. They were essentially pouring their savings into rebuilding their devastated economies.
So they were basically emptying their piggy banks, using their hard-won reserves just to get the most basic supplies and rebuild, while the U.S. economy was booming from all this export demand.
Exactly. The sheer scale was immense. Total foreign holdings of central gold and banking funds in the U.S. declined sharply. From a peak of about $23 billion during 1939-45, down to around $18 billion by the end of 1947.
Wow.
And to put that in perspective, in terms of purchasing power, these holdings were less than half of what they were back in 1938. The newly established International Monetary Fund, IMF, which officially began operations in 1947, provided drawing rights as a new, albeit limited, form of international reserve.
Drawing rights. How did those work?
These drawing rights allowed member countries to draw on the IMF's pool of currencies, mainly dollars, to meet short-term balance of payments needs. It was a form of conditional credit, not a direct asset like gold.
Okay.
And its resources were limited, meaning countries like the UK and France quickly made significant drafts. This rapid liquidation of foreign gold and dollar reserves actually had significant expansionary effects on the U.S. domestic monetary and credit situation. It expanded bank reserves and deposits at a time of immense global demand for U.S. goods.
So this initial post-war demand for dollars was huge, fundamentally strengthening the U.S. economy. But the true solidification of the dollar's global power, particularly in a world no longer anchored to gold, that would come with another pivotal and maybe surprising agreement. This sets the stage for the Petrodollar, right?
It absolutely does, host. The Petrodollar system, although it was never a single formal treaty, represents a monumental shift. It tied the dollar to the world's most vital commodity, oil. Let's fast forward to the 1970s. The U.S. was grappling with high inflation, large current account deficits, significantly exacerbated by the Vietnam War,
Right.
and a dollar that was no longer convertible to gold since President Nixon unilaterally ended gold convertibility in 1971, the Nixon shock. Then, in 1973, the Organization of Petroleum Exporting Countries, OPEC, dramatically cut production and embargoed shipments to certain nations. This caused a massive global oil shock and sent prices absolutely skyrocketing.
Amidst this turmoil, with the U.S. economy struggling and the world reeling from energy prices, what was the Nixon administration's goal when they embarked on that crucial diplomatic mission to Saudi Arabia in 1974? Was it just about getting the oil flowing again?
That was certainly a critical immediate goal, as documented in historical records, to ensure a stable supply of oil. Absolutely. But a key long-term aspect of this diplomatic effort, led by then-Secretary of State Henry Kissinger, was to encourage Saudi Arabia to use its massive and rapidly growing dollar revenues from oil sales to buy U.S. treasuries and other dollar-denominated assets.
Right.
In exchange for this commitment to recycle their petrodollars, Washington promised to supply Saudi Arabia with advanced military equipment and, crucially, protect Saudi national security. This was a strategic partnership aimed at both economic and geopolitical stability.
So it was a quid pro quo that created this powerful, self-reinforcing system. Tell us more about how the petrodollar system actually worked in practice.
Well, while there wasn't a single official agreement signed on the dotted line, it was more of an understanding and practice that evolved. The prevailing system, which came to be known as the petrodollar system, involved Saudi Arabia effectively committing to channel its vast oil earnings, which were denominated exclusively in dollars, back into the U.S. financial system, particularly by purchasing U.S. government debt.
Right.
This arrangement was like a global currency recycling machine. Oil flowed out of Saudi Arabia, denominated in dollars. Those dollars flowed into Saudi coffers, and then those dollars were recycled back into the U.S. financial system by purchasing U.S. treasuries and other assets.
And how did that recycling mechanism fundamentally help the dollar, especially in a post-gold world? What was the impact?
Oh, it was incredibly effective. This arrangement helped to stabilize demand for the dollar by ensuring a constant, massive global need for dollars just to buy oil. It powerfully promoted the dollar's use not just in global oil trading, but across a wide range of other commodities, too.
Right, it became the standard.
Exactly. And crucially, it created a steady, immense source of demand for U.S. treasuries. This helped finance U.S. government spending and keep interest rates lower than they might otherwise have been. All of this significantly strengthened the dollar's position as the world's key reserve, financing, and transactional currency. Saudi Arabia, often referred to as the swing factor, because of its ability to influence global oil prices by increasing or decreasing production. This arrangement tied their immense economic power closely to the stability and use of the dollar. It underpinned the dollar's global status for decades.
That's a powerful feedback loop, really securing the dollar's place at the center of the global economy after the end of gold convertibility. Okay, so another knowledge gap emerges here. The source notes the IMF's role in providing drawing rights after WWII. How did these drawing rights function in detail, and how did they differ from simply holding gold or foreign currency reserves? What were the mechanics? Now let's shift gears a bit to Section 2. The Eurodollar market, a financial innovation story. This is where we dive into something that sounds like it could be from a spy novel, but it's pure finance. The Eurodollar.
Yeah.
It's a concept that sounds complex, maybe, but at its heart, it's actually quite simple.
Exactly. A Eurodollar is essentially just a U.S. dollar deposit held in a bank outside the United States.
Yeah.
It's still a dollar. It's still a promise to pay U.S. currency, but because it's domiciled in a foreign bank, it's not subject to the same strict regulations as dollars held within the U.S. Think of it as a U.S. dollar that has traveled abroad, found a new home in, say, London, and started operating under a different set of local banking rules. It's a dollar, but with an international passport, so to speak.
That's a great analogy. Now, many traditional accounts of the Eurodollar market's origin point to factors like Cold War fears, maybe Russians depositing dollars in London to avoid potential U.S. confiscation,
Right.
or U.S. interest rate ceiling, specifically something called Regulation Q, which limited the interest payable on deposits in the U.S., or even U.S. balance of payments deficits pushing dollars out. Are these the full stories of its emergence?
Well, while those were certainly important environmental factors that shaped the market's growth and appeal once it was established, our deep dive into the historical records reveals they weren't the precipitating spark for its innovation.
Not the trigger.
Not the initial trigger, no. For example, Regulation Q, which set maximum interest rates banks could pay on certain deposits in the U.S., had actually been in force since the 1930s, long before the Eurodollar market truly took off in the mid-1950s. While it definitely made foreign deposits more attractive later, it wasn't the initial catalyst. The true genesis, the spark, can be traced to a specific act of financial ingenuity by Midland Bank in London in mid-1955.
Midland Bank, okay.
Yes. This period was marked by a tight monetary policy in the UK, with the bank rate, the official interest rate, reaching a post-war high of 4.5%. This created a significant gap between the high returns available on sterling assets like treasury bills and the much lower fixed interest rates offered by clearing banks on traditional sterling deposits. That was due to informal self-denying ordinance agreements among banks not to compete aggressively for sterling deposits.
Ah, so a unique set of specific economic conditions in London created a perfect breeding ground for this innovation. How did Midland Bank manage to seize this opportunity and create the first Eurodollar transaction? What did they actually do?
Midland Bank saw a clear opportunity for what's called interest rate arbitrage. They began bidding up to 178% interest for 30-day deposits denominated in U.S. dollars.
Okay.
Now, that was a significantly higher rate than the maximum 1% that could be earned on a similar deposit in the U.S. under Regulation Q at the time. So that was attractive to dollar holders.
Right.
Midland then took these newly acquired dollar deposits and immediately sold them for sterling in the spot market and simultaneously bought them back in the forward market at a premium.
Bit complicated.
It sounds complicated, but this clever maneuver effectively allowed them to obtain sterling at a total cost of around 4%, which was still cheaper than the prevailing bank rate of 4.5% they would have had to pay for sterling domestically. It was a completely new and more cost-effective way for them to attract funds and meet their liquidity needs in that tight sterling market.
So, like a very savvy international shopper, finding a fantastic deal on a product in one market, then immediately reselling it for a profit in another market where demand is higher, even after accounting for the currency exchange and transaction costs. That's incredibly clever and precise. What legal or regulatory change enabled them to execute this multi-currency arbitrage? Something must have allowed it.
Yes, exactly. A key legal change that enabled this was the authority quietly given to UK banks in September 1954 through a specific directive known as Notice to Banks and Bankers EC General 54. This directive liberalized exchange controls and allowed UK banks to sell US or Canadian dollars forward against sterling. Prior to this, such forward currency operations were highly restricted. This specific liberalization made interest arbitrage across currencies possible, laying the crucial groundwork for the entire Eurodollar market to flourish. Without this particular regulatory shift, Midland Bank's innovative strategy just wouldn't have been viable.
That's a crucial detail. Understanding the specific regulatory flexibility that truly enabled this market to take root. Okay, before we delve into how London capitalized on this, my knowledge gap question for you is, what were the specific terms and implications of Regulation Q? And how did it influence the decision-making of U.S. depositors back in the mid-1950s, prompting them to actively look for alternatives, like Eurodollar deposits, even beyond the interest rate differential Midland was exploiting? What were the nuts and bolts of Reg Q?
That's a great question, because while Regulation Q played an environmental role, it was London's unique regulatory stance that truly propelled the Eurodollar's growth. Once Midland Bank sparked this innovation, it didn't just stay with them. The Bank of England was initially quite concerned about Midland Bank's innovative practices.
Oh, really?
Yes, they saw them as potentially violating the spirit of monetary constraint that was in place to control inflation at the time. However, after considerable internal debate, they made a crucial strategic decision. They would not intervene to restrict this new business.
Interesting. Why not?
They understood that trying to regulate it too tightly would simply drive the burgeoning Eurodollar business away to other, more permissive financial centers, like maybe Zurich or Paris, that would ultimately harm London's long-standing role as a global financial hub. Plus, the UK's existing exchange control system was primarily designed to prevent capital outflows, not inflows of foreign currency. So inward flows were inherently harder to control effectively anyway. This reluctant toleration became a significant, almost accidental, competitive advantage for London.
So London's regulatory authorities essentially chose pragmatism over strict control, understanding that fostering innovation, even if a little unconventional, would ultimately serve their larger interest in maintaining financial leadership. It's like a bustling marketplace where most stalls have strict rules on what you can sell and how. But one stall owner in London decides to be more flexible, within reason. Soon, all the savvy traders flocked to that flexible stall, making it the most dynamic and profitable place to do business.
Exactly right. And London's edge was further sharpened by restrictive policies in other major European countries. In the early 1960s, for instance, Switzerland, another major financial center, enacted a gentleman's agreement among its banks specifically to discourage short-term foreign currency deposits.
Discouraged them.
Yes, even going so far as to charge commissions on withdrawals for non-residents. Simultaneously, France and Germany also prohibited interest payments to foreigners on certain types of deposits, further limiting their attractiveness. And France and Italy explicitly banned swaps from Eurodollars to local currencies, effectively closing off a key arbitrage avenue.
Wow.
These policies effectively acted like a series of financial dominoes, each one pushing capital away from its own market and causing it to fall one after another into the welcoming arms of London. It significantly enhanced London's competitive advantage and cemented its role as the undisputed Eurodollar hub.
That makes perfect sense. So once London became this welcoming hub, how quickly did this innovation spread? And what new forms did it take? Did it stay niche?
Oh, not at all. While Midland Bank pioneered the Eurodollar, it quickly lost its initial advantage as other institutions, both British and foreign, jumped into the burgeoning market. By the end of 1962, U.S. banks with London branches actually held the largest share of Eurodollar deposits, around 27%. They were followed by British overseas banks and accepting houses.
And others.
Japanese banks were also particularly active. They attracted over $200 million by September 1960. They often converted these Eurodollars to yen to finance Japan's rapidly industrializing economy at a cheaper rate than domestic borrowing allowed. This shows how the market quickly became global in its reach and participants.
So it wasn't just about switching dollars to sterling anymore. The uses for Eurodollars were evolving and diversifying rapidly, right? It wasn't just that initial arbitrage play.
Absolutely. Initially, yes, many Eurodollars were indeed switched into sterling for short-term investments in the UK, like investing in treasury bills or making loans to local authorities. However, by 1960, only about 15% were used this way. That indicates a rapid shift towards broader international lending.
Yep.
U.S. banks often channeled these deposits back to their head offices in New York or used them for extensive European lending, facilitating post-war reconstruction and growth. Japanese banks, as we mentioned, use them for domestic industrial expansion. And crucially, a major new product emerging from this market was the Eurobond.
The Eurobond, right.
First discussed in late 1962 for foreign government issues. Unlike traditional bonds issued in a single national market and subject to its regulations, Eurobonds are issued by international syndicates, sold to investors in multiple countries, and denominated in a currency other than that of the country of issuance. This marked a completely new, flexible way to fund international loans and investment projects, further expanding the market.
And where were all these dollars coming from?
The primary source of these burgeoning Eurodollar deposits was the increasing supply of U.S. dollars outside the U.S., largely due to America's persistent balance of payments deficits from things like foreign aid and military spending. A significant portion came from European commercial and central banks holding these dollars.
The market really diversified quickly then, innovating beyond its initial arbitrage roots into a cornerstone of international finance. Okay, my next knowledge gap question for you is this. The source mentions Eurobonds as a new product and how they differed from traditional bonds, but specifically what made them so attractive to foreign governments and multinational corporations looking to raise capital beyond just the international syndicate aspect. What were the key advantages? We've tracked the dollar's incredible journey through history from its unexpected rise, that duopoly, the genesis of the Eurodollar market. Now, let's fast forward to the present day and dive into Section 3. The dollar today, dominance and emerging challenges. It's clear that the U.S. dollar's preeminent role today is deeply rooted in the sheer size and strength of the U.S. economy, its remarkable stability, its openness to trade and capital flows, strong property rights, the rule of law, all that. This unique combination creates unmatched depth and liquidity in U.S. financial markets, offering a vast supply of extremely safe dollar-denominated assets. It really is like the bedrock of a massive global financial skyscraper, the most reliable foundation for international transactions and reserves.
That's a perfect way to put it, host. This enduring strength supports the dollar in multiple critical functions, and one of the most important is its pervasive role as a store of value. As of 2024, the dollar still comprises a significant 58% of disclosed global official foreign exchange reserves.
58%. Still huge.
It's a truly dominant share, far surpassing the euro at 20%, the Japanese yen at 6%, the British pound at 5%, and the Chinese renminbi way down at just 2%. Now, while the share is notably down from its 2001 peak of 72%, largely due to an increase in other reserve currencies, not a direct divestment from the dollar itself, it has actually been remarkably stable since 2022 and matches its 1995 level. That demonstrates its persistent strength.
That's a huge proportion of the world's financial safety net. But what about gold? I keep hearing about central banks buying more gold these days. Does that signal a significant shift away from the dollar as a store of value? Is that de-dollarization in action?
That's a very insightful question, and it's a common misperception, actually. While gold's share in official reserves has seemingly doubled since 2015 to over 23%.
Right, it sounds like a big jump.
It does, but this largely reflects a 200% increase in the price of gold over that period, not a significant increase in the physical quantity of gold held.
Oh, okay, price effect.
Exactly. In fact, the physical quantity of gold held by central banks rose less than 10% in that same time frame. So for most countries, increased gold holdings are not directly linked to a decline in their dollar reserves. Instead, it's often a result of diversification strategies or just the rising market value of existing gold holdings. Now, China, Russia, and Turkey are notable exceptions. They have been actively increasing their physical gold holdings while also reducing their dollar exposure, often for geopolitical reasons. But for the vast majority, gold complements, rather than replaces, dollar reserves.
That clarifies it beautifully. So the dollar is still very much the leader in reserves, and I imagine a substantial portion of those reserves are held in U.S. treasuries.
Precisely. The bulk of official U.S. dollar reserves held by foreign central banks and governments are invested in highly demanded U.S. Treasury securities. These are considered among the safest and most liquid assets in the world. In the first quarter of 2025, a staggering 32% of all marketable treasuries outstanding, that's approximately $9 trillion worth, were held by foreign investors, both official institutions and private entities.
$9 trillion.
Wow. And this share has been consistently stable since 2022 and is comparable to other major economies' government debt holdings by foreign entities. Beyond these digital and paper assets, get this, over $1 trillion in U.S. dollar banknotes, physical cash, roughly half of all outstanding physical dollar banknotes, were held abroad in Q1 2025.
$1 trillion in cash outside the U.S.
Yep. These serve as a global store of value, particularly in economies with less stable local currencies or during times of crisis. Though it's worth noting, the growth of physical banknote holdings abroad has slowed recently, partly due to higher U.S. interest rates making interest-bearing deposits more attractive, and also the rise of dollar-backed stablecoins offering a digital alternative.
It's truly incredible how many physical dollars are circulating globally, acting as a financial safe haven for people beyond U.S. borders. So it's a critical store of value, and it also acts as an anchor for many other currencies around the world.
Absolutely. The dollar's stability and reliability make it an ideal anchor. In 2019, over half of all countries explicitly used the U.S. dollar as an anchor for their own currencies, either by directly pegging their currency's value to the dollar or by limiting its movement within a narrow band relative to the dollar. This widespread practice highlights the global confidence in its stability and its role as a benchmark. Think of the dollar as the dominant operating system for the global financial computer. While other apps, other currencies certainly exist and are vital for local functions, the dollar's ecosystem provides the most comprehensive, liquid, and supported environment for all major financial operations worldwide, from trade to investment.
That's a powerful analogy. And beyond acting as a store and an anchor, the dollar is overwhelmingly used as a medium of exchange, meaning it's the go-to currency for actual day-to-day international transactions, right? For buying and selling stuff globally.
That's correct, and the data really underscores this dominance. The dollar is overwhelmingly used in global trade invoicing. Between 1999 and 2019, it accounted for an astonishing 96% of trade invoicing in the Americas, 74% in Asia-Pacific, and 79% in the rest of the world.
Huge numbers.
Massive. Europe, where the euro naturally dominates interbloc trade, is the main exception. When we look at international payments on SWIFT, that's the Society for Worldwide Interbank Financial Telecommunication, Basically, the secure messaging network banks use for transactions.
Like the plumbing.
The plumbing, exactly. The dollar share there is around 50%. This figure rises to about 60% if you include intra-euro area payments. And notably, its share has even slightly increased in recent years, demonstrating its enduring utility.
That's a huge share of daily global financial traffic. It truly highlights how central the dollar is to the mechanics of international trade and banking.
And it extends into every corner of global finance. The dollar consistently dominates international banking claims, accounting for approximately 55%, and liabilities around 60%. It also leads in foreign currency debt issuance, consistently around 60%, a trend that has held steady since 2010. And in the massive, intricate foreign exchange markets, the 2022 BIS Triennial Survey showed the U.S. dollar was bought or sold in about 88% of all global FX transactions.
88%.
88%. That share has remained remarkably stable for the past 20 years. This means almost every currency exchange involves the dollar at some point.
That's truly pervasive. And the Federal Reserve, the U.S. Central Bank, actively supports this role, doesn't it? Especially in times of crisis, providing essential liquidity.
It does, and this is a critical pillar of its modern dominance. The Federal Reserve actively supports the dollar's international role, particularly during periods of global financial stress. For instance, during the 2008-2009 global financial crisis, and again during the 2020 COVID-19 crisis, the Fed swiftly introduced and expanded temporary and permanent swap lines with foreign central banks.
Swap lines, right?
These swap lines are agreements where the Fed lends dollars to a foreign central bank, which then lends those dollars to its own domestic banks. This provides essential, stable dollar funding when global markets tighten, preventing liquidity crunches. These lines were extensively used, with outstanding totals reaching $585 billion and $450 billion, respectively, in those crises. Meanwhile, non-dollar swap lines saw comparatively little usage.
Tells you where the demand was.
Absolutely. Furthermore, the FEMA repo facility, made permanent in 2021, offers another mechanism. It allows foreign monetary authorities to temporarily raise dollars by selling U.S. Treasuries to the Fed and buying them back later. It provides an additional backstop for dollar liquidity. These facilities underscore the dollar's crucial role by ensuring its liquidity and stability across the global financial system, especially when it's most needed. Overall, an aggregate index of international currency usage, combining 5 key measures, shows the dollar's index level has remained in a narrow range between 65 and 70 since 2010, significantly ahead of all other currencies.
That paints a picture of incredible stability and multifaceted dominance.
But with all this talk of its entrenched position, what about the idea of de-dollarization that we hear so much about? The text mentions that U.S. sanctions on Russia haven't caused a notable reallocation of reserves. Why might countries, particularly geopolitical adversaries, still choose to hold significant dollar reserves despite the very real fears of the dollar being weaponized? And what's the practical reality that makes it so difficult to divest? That's our next knowledge gap.
That brings us directly to the de-dollarization debate and the future landscape. Indeed, 50 years after that informal petrodollar understanding with Saudi Arabia, the landscape is showing signs of shifting, at least around the edges. Saudi Arabia's approach remains a key harbinger, a bellwether of the financial future. With the U.S. now the world's largest oil producer, thanks to the shale revolution, and China emerging as Saudi Arabia's largest oil customer.
All right, big shift. Riyadh is actively diversifying its international relations beyond its traditional allies in the U.S. and Europe. Its willingness to join the BRICS group of emerging nations, Brazil, Russia, India, China, South Africa, and now expanded, and participate in projects like mBridge. That's a collaborative initiative involving central banks from China, Hong Kong, Thailand, and the UAE, exploring how central bank digital currencies can facilitate faster, cheaper, cross-border payments. These are seen as small but symbolic steps down the road toward de-dollarization.
So these are early, visible signs of a powerful river starting to change its course, perhaps. Not a sudden reversal, but new tributaries forming that could, over a very long time, significantly alter the flow.
That's a very apt analogy, host. The movement toward de-dollarization generally involves countries increasing the use of their local currencies for cross-border trade and investment, establishing direct currency swap lines between central banks to bypass the dollar, linking national payment and settlement systems to create alternative rails for transactions. Now, while currently entailing efficiency costs, primarily due to less liquid local foreign exchange markets and higher transaction costs compared to the dollar's vast ecosystem, many countries appear to accept this as a necessary trade-off.
A price worth paying for autonomy.
Perhaps, to reduce their reliance on the dollar and gain more financial autonomy. And crucially, advances in digital payment technology, like tokenization of assets and the development of central bank digital currencies, CBDCs, could significantly reduce these efficiency costs in the future and potentially lessen the immediate need for countries to hold large dollar reserves just for international transactions.
What then are the biggest challenges people point to regarding the dollar's dominance today? Geopolitical sanctions often come up as a major concern for some countries, as we just touched on.
Indeed, geopolitical sanctions are frequently cited. Commentators argued quite strongly that U.S. sanctions on Russia following the 2022 invasion of Ukraine would significantly make the dollar less attractive as a reserve currency, prompting widespread divestment.
Made sense logically.
It did. However, as of 2025, there has been no notable decline or reallocation in global dollar reserves. This is largely because the other major reserve currencies, the euro, Japanese yen, and British pound, are issued by close U.S. allies who also participated in the sanctions. This leaves geopolitical adversaries with very few truly attractive, liquid, and stable alternatives for their large-scale reserve needs. The sheer depth and liquidity of dollar markets just remain unparalleled. There's nowhere else to put trillions safely and easily.
That's a crucial point. It seems there isn't an easy off-ramp from the dollar for countries that might want one, especially given the lack of truly independent large-scale alternatives. What about the euro? Could increased European integration challenge the dollar more effectively?
It's a possibility, but it's a long-term play with significant hurdles. The European Union is, of course, a massive economy with deep financial markets. The unprecedented issuance of jointly backed EU debt around $700 billion by May 2025, mainly to fund post-pandemic recovery, could, if fiscal integration progresses substantially and a truly large, liquid, unified EU bond market develops.
Very if.
A very big if. Then it could make the euro significantly more attractive as a reserve currency. However, that $700 billion is still relatively small compared to the over $28 trillion in U.S. treasuries. And fundamental political uncertainty and diverging fiscal policies among diverse Eurozone countries remain a significant constraint on developing that unified, massive supply of safe assets that truly rivals the dollar. The euro simply lacks the singular, unified issuer and vast, homogeneous bond market that the U.S. Treasury offers.
And China. With its massive economy, one would naturally expect the Chinese renminbi, the RMB, to be a major challenger to the dollar. Why isn't it making more headway?
China is undeniably a significant global player. World's largest exporter, economy surpasses the U.S. in purchasing power parity terms already. However, significant structural roadblocks continue to hinder the Chinese renminbi's internationalization. Critically, it's not freely exchangeable on global markets. Its value is still heavily managed. China's capital account is not fully open, restricting the free flow of money in and out.
Right, capital controls.
Exactly. And perhaps most importantly, investor confidence in Chinese institutions, particularly regarding legal recourse and transparency, is relatively low compared to Western markets. Despite China's active efforts to promote the RMB, its aggregate index of international currency usage still lags behind even the yen and the pound. The RMB is held back by these fundamental limits on capital mobility and a perceived lack of legal predictability.
And what about the rapidly shifting payments landscape with digital currencies? Could the rise of private stablecoins and central bank digital currencies disrupt things enough to challenge the dollar?
It's a fascinating and rapidly evolving area with, well, paradoxical effects right now. The rapid growth of digital currencies, both private stablecoins and CBDCs, could theoretically reduce reliance on the dollar by offering alternative payment rails. Faster, cheaper transactions, maybe? However, and here's the paradox, about 99% of stablecoin market capitalization is currently linked to the US dollar.
99%. So they're basically digital dollars.
Essentially, yes. This suggests that these crypto assets, rather than challenging the dollar, actually reinforce dollar usage right now. They're creating synthetic dollars that are easier to use across borders, potentially leading to increased dollarization in emerging markets that lack robust financial infrastructure. Now, the development of CBDCs like Enbridge could offer non-dollar alternatives down the line, but their adoption and impact remain to be seen on a global scale. So for now, it's less about replacing the dollar and more about making it even more accessible in new digital forms.
So, looking ahead, is it a multi-currency world we're inexorably heading towards? Or will the dollar remain the sole superpower of global finance for the foreseeable future?
Well, while the dollar's overwhelming dominance is widely expected to remain stable in the foreseeable future, many economists and analysts do foresee a gradual democratization of the global financial landscape potentially underway. This isn't a sudden revolutionary shift, but a slow evolution. It could lead to a future world where the dollar remains prominent, perhaps still the most important currency, but is increasingly complemented by other currencies. The Chinese renminbi, the euro, the Japanese yen, each reflecting their respective economies' international footprints.
A more multipolar system.
A truly multi-currency world rather than a single hegemon. But the dollar status is likely to remain secure, absent any large-scale lasting disruptions which damage the fundamental value of the US dollar as a store of value or medium of exchange and simultaneously bolster the attractiveness of dollar alternatives. It fundamentally boils down to trust, liquidity, safety, and the lack of viable large-scale alternatives right now.
That's a nuanced and thoughtful outlook. Okay, my final knowledge gap question for this deep dive is, given these long-term trends and emerging challenges, what are 2 to 3 specific, proactive policy actions the U.S. could take today, beyond just crisis intervention, to intentionally shore up the dollar's international role for the next, say, 50 years? How can it ensure its continued appeal in a potentially more multipolar financial world?
Wow, what a journey we've undertaken today. We've really covered some ground. We've traveled from the interwar period, seeing the dollar rise dramatically, that surprising comeback by sterling, through the birth of the petrodollar system that really solidified its post-war might, all the way to its current multifaceted dominance, and these very real conversations about what the future holds for global finance.
What's abundantly clear, I think, is that the dollar's international role is this complex tapestry. It's woven from economic might, profound political influence, relentless financial innovation, like the Eurodollar market.
Yeah. And even the nuanced, sometimes reluctant regulatory choices of different nations, like the Bank of England's decision back then. It's never a simple, linear story, is it? It's one of constant evolution, adaptation, and intense competition for financial leadership.
Absolutely. And the history of reserve currencies, from the Dutch guilder way back to the British pound to the US dollar, it teaches us that ultimate power often lies in something surprisingly intangible: confidence.
Confidence, yes.
The dollar's staying power, even amidst significant challenges like sanctions, rising competitors, digital currencies, it's a testament to the world's enduring faith in its stability, its liquidity, and the rule of law underpinning the U.S. financial system. But as we look ahead, what would it truly take to shake that global confidence in a lasting way? And what exactly would be robust enough, deep enough, trusted enough to replace it?
That is the profound question indeed. Because the stability, the transparency, the predictability of a nation's institutions of financial markets often seem to outweigh even sheer economic size when it comes to maintaining a currency's international role. It's not just about what you produce, but how reliably you govern your financial system and protect investor rights over the long haul.
So the next time you see headlines about de-dollarization or currency wars, hopefully you'll have a much deeper understanding of the immense multi-layered forces at play. We encourage you to keep observing how these narratives unfold and to ask those deeper questions, because that's how we all become truly well-informed in this ever-changing global financial landscape.